Imagine a single tulip bulb worth more than a mansion, or a company with zero profit valued higher than the entire aviation industry. History is littered with the corpses of sure things. Today, as Nvidia stock pushes toward a $5 trillion valuation, the world is asking one question. Is the AI bubble the greatest wealth creator in human history, or just the latest echo of a 400-year-old trap? But here's the part they aren't telling you on the news. The AI revolution isn't just fighting market gravity, it's hitting a physical wall. As of March 2026, the U.S. national debt has officially crossed $39 trillion. While we argue over chatbots, the interest alone is costing us $2 million every single minute. We are headed for a collision between infinite digital ambition and finite physical resources. To see how this ends, we have to look at the ancient history of money. To understand economic history explained, we have to go back to 1636. This is Tulip Mania. It wasn't just about flowers, it was the birth of the speculative forward contract. At its peak, a single viceroy bulb could buy you 12 acres of land or a small fleet of ships. The financial history explained here is a lesson in human psychology. When the price of an asset is driven purely by the greater fool theory, the belief that someone else will pay more tomorrow, the value is no longer in the asset, but in the collective delusion. When the Dutch auctions finally failed in February 1637, the market didn't just dip, it vanished. This pattern repeated in the 1720s with the South Sea bubble, where even Sir Isaac Newton lost his fortune, famously stating he could calculate the motions of the heavenly bodies, but not the madness of people. In every instance, the narrative was the same. This technology changes everything. In the 1700s, it was global trade. In the 1990s, it was the internet. Today, it is artificial intelligence. But math is the ultimate regulator. When the cost of capital rises, the greater fool disappears. We see this today as Nvidia stock became the first company to ever hit a $4 trillion market cap in 2025, and then $5 trillion by early 2026. Let's talk about the titan of 2026, Nvidia stock. In February 2026, Nvidia reported a staggering $78 billion in quarterly revenue. Their data center business, the backbone of the AI economy, is off the charts. CEO Jensen Huang claims we've entered a virtuous cycle of growth. But economic history explained by the dot-com bubble tells a different story. In 1999, Cisco Systems was the picks and shovels king of the internet. Everyone needed their routers to build the web. Cisco became the most valuable company on earth until the web builders ran out of cash. The AI bubble is facing a similar pick and shovel trap. While Nvidia makes billions selling chips, the companies buying them, OpenAI, Microsoft, and Google, are still waiting for the ROI. In early 2026, Nvidia shares dropped 17% in a single day after the launch of the Chinese chatbot DeepSeek, which proved that high-end AI could be run on significantly cheaper, older hardware. This revealed a massive crack in the armor. Nvidia's massive margins are only sustainable if they maintain a total monopoly on high-end compute. If the miners realize there isn't enough gold to pay for the shovels, the shovel seller is the first to fall. Currently, OpenAI is projected to report $74 billion in operating losses by 2028. That is a money echo that should keep every investor awake at night. This is the story no one is telling you. The AI bubble isn't just a financial risk, it's an energy crisis. By March 2026, global data centers are consuming over 500 terawatt hours of electricity, roughly 2% of all power on Earth. In the US, AI infrastructure now consumes 4% of the national energy mix. Experts warn that by 2028, that could jump to 12%. Training a single leading AI model now requires 25 megawatts of power, and that requirement is doubling every year. We are seeing a repeat of the 1970s energy crisis, but instead of cars needing oil, we have servers needing electricity. Tech giants like Amazon and Microsoft are now being forced to buy decommissioned nuclear reactors and invest in experimental hydrogen fuel cells just to stay online. But there is a limit to how fast we can rebuild a national power grid. In 2026, we are reaching the energy choke point. In Northern Virginia, the data center capital of the world, power companies have already begun telling tech firms they cannot guarantee new connections for years. If the cost of power exceeds the value generated by the AI, the economics collapse. This is history and finance colliding with the laws of thermodynamics. But before we look at the debt, we have to address the silicon silver bullet argument. If you listen to the techno-optimists in Silicon Valley, they'll tell you that the energy cost doesn't matter. They argue that AI will become so efficient at solving physics, materials science, and fusion energy that it will eventually pay for itself by creating a world of infinite cheap power. Let's steelman this perspective for a moment. The argument is that we are in the Gutenberg phase. When the printing press was invented, the cost of a book dropped by 99% over a few decades. It didn't matter how much wood or ink was used, because the resulting explosion in human literacy and scientific progress created trillions of dollars in value. The optimists believe AI is the ultimate efficiency engine, that it will optimize our power grids, find new battery chemistries we haven't dreamed of, and manage the $39 trillion debt by automating the entire global bureaucracy. It's a beautiful vision. But here's the problem. Efficiency doesn't always lead to lower consumption. In economics, we call this Jevons Paradox. Back in the 19th century, economist William Stanley Jevons noticed that as steam engines became more efficient, using less coal to do more work, the total consumption of coal didn't go down. It skyrocketed. Why? Because as the cost of steam power dropped, we found 1,000 new ways to use it. We didn't just run the same factories with less coal, we built 10,000 new factories. We are seeing the exact same pattern with AI in 2026. Every time Nvidia releases a chip that is 2 times more energy efficient, developers don't use 50% less power. They build models that are 10 times larger. We aren't using AI to save the grid, we are using the grid to feed the AI. And this creates a productivity mirage. We are generating millions of lines of code and billions of AI images, but we aren't seeing that translate into the physical world of bridges, houses, or food. We've built a digital skyscraper on a crumbling physical foundation, and this is where the energy choke point meets the financial end game. Because to fix the energy grid, you need a massive physical investment. You need copper, steel, concrete, and labor. But as of March 2026, the money required to build that physical future is being swallowed by the largest black hole in human history, the interest expense. Now we look at the most dangerous variable, ancient history money principles colliding with modern debt. As of March 2026, the U.S. gross national debt is $38.86 trillion, on its way to hitting $39 trillion by the end of the month. We are increasing our debt by $7.23 billion every single day. For the last 40 years, the wealth machine ran on cheap credit. But in 2026, the average interest rate on our debt has climbed to 3.35%. This means we are now paying more in interest than we spend on our entire military. Speculative bubbles like the AI bubble require cheap money to survive. When the government has to borrow trillions just to pay the interest on previous loans, it crowds out private investment. In Financial History Explained, this is known as a debt spiral. In the 4th century, the Roman Empire faced a similar crisis, devaluing its currency to pay for an overextended state until the economy simply stopped functioning. When the liquidity dries up to pay the interest on $39 trillion, the stock market is usually the first place the money is pulled from. History isn't a straight line, it's a circle. From the Dutch tulips to the Nvidia stock surge of 2026, the human desire for a shortcut to wealth never changes. The AI revolution is real, but the valuations are a money echo of every bubble that came before it. We are entering a once-in-a-lifetime global wealth rotation. Money is moving away from the digital clouds and back toward the physical backbone of the economy, energy, minerals, and real assets. The question isn't whether AI will change the world. It will. The question is whether you will be holding the bag when the energy bill for $39 trillion comes due. As the grid groans and the debt clock ticks, the smart money is following the lessons of ancient history money. Don't be the last one holding a tulip in a world that needs electricity. What is your next step? Are you holding AI stocks, or are you moving to hard assets? Let us know in the comments. Subscribe to Money Echoes to understand the hidden economics of history. We don't just read the news, we follow the money. History does not just repeat, it rhymes. So make sure you are listening for the next Money Echoes. Subscribe, and I will see you in the next one.